All right, folks, we are going to narrow our focus now to talk about an investment idea that was very popular not long ago, but has since fallen out of favor. We are talking about SREITs, and you definitely don't want to miss this next session because it's a rare opportunity to have not one, not two, but three CEOs on the panel discussion with us in the next session. But to start us off, I'm going to hand the time over to Miss Natalie Ong from Phillip Securities Research. Natalie, over to you.
Hi, Edward, and good morning to everyone. I'll just start off by sharing my screen. Okay, I think you should be seeing it right now. Okay. So we'll just start off by saying, so in this segment, we'll be talking about, are REITs still attractive, especially, in view of this rising interest rate environment. And just to jump right in, now you'll be looking at this chart, which shows us how the REITs, the REIT share performance versus the yield curve, the historical yield curve. And we can see that initially in the light blue line, which is the yield curve, in periods where the yield curve is on the downtrend, you can see an inverse relationship with the REIT share price, meaning to say that it will rise when the yield curve is dropping, when interest rates are rising. And this is where we are right now. To the right hand side of the graph, right now where we are entering this new economic phase, right? So in a way of saying, we are expecting that that there should be some upside potential for REIT share prices coming into this new cycle. And why is that so? While rising interest rates are a headwind for the REITs, we see that the S-REITs have actually employed a relatively high average interest rate hedge of about 70%. It ranges between 65% to 100% for the REITs, for the S-REITs. Also, even though the REIT index share price has not yet recovered back to pre-pandemic levels, and this is because it's been weighed down by several subsectors, namely your retail, hospitality, as well as some of your office counters. And as the economy reopens, as relaxation in restrictions are rolled out, and reopening of borders, we should expect that there could be more upside or recovery for the REITs. Lastly, even though the pandemic years of 2020 and 2021 was very difficult for most of the counters, our REIT counters, the CEOs, the REITs, they were not sitting on their hands. They were being very active in terms of portfolio rebalancing, and these rebalancing efforts has actually strengthened the REIT portfolios. In 2021, we saw almost 13 billion in acquisitions concluded by the REITs. And so this should put the REITs on a stronger footing as we enter, this recovery phase. So now moving on to valuations. How do valuations look? In this chart, we are looking at, on the left-hand side, the forward dividend yield. So the forward dividend yield looks a little bit expensive as it is below the red color line being the average 10-year forward dividend yield. Also, bear in mind that this is because DPUs are still recovering and there's still more runway for growth. On the right-hand side, we're looking at the price to NAVs. Similarly, it does look a little bit expensive. However, we do think that there are still some pockets of value within the S-REITs. Okay, in this next slide, what we're looking at right now is how the REITs DPU are expected to trade, or rather the forward DPU yields for FY22, as well as the DPU growth in FY22. This is, of course, based on consensus forecast. And we can see that at the top right-hand side, boxed up in orange, are the overseas S-REITs. So these S-REITs, they tend to trade at a higher dividend yield, and this is because most of the assets are actually located overseas, and that in a sense, because we are investors, Singapore investors are unable to physically view them, they command a premium yield. And then we have the green color box, which is the opening or the recovery place. And those are largely your retail as well as your hospitality counters. So just do bear in mind that the retail and hospitality counters, most of them are still not yet back at pre-pandemic DPU, especially for the hospitality side. We do expect some recovery. And that being said, these two sectors are still trading at below pandemic yields. And right in the middle, we are looking at what I would term as stable performers. So largely, some of your industrial names as well as some of your office names. And that is where they're still offering decent yields, ranging between 4 to 6.5%, or rather 4 to 7%. And also there is upside, or rather there is DPU growth potential for some of these names. Okay, and looking at on the right hand side, we'll be talking a little bit about our Phillip outlook for the REITs by subsector. So we are overweight on the industrial subsector because the industrial classes of logistic high spec, business parks, as well as data centers, these are all catering to new economy kind of industries, and by virtue, because they are holding these kind of assets, we do see that they are able to capture this new economy demand, which is now experiencing structural and secular kind of growth. Not to mention, the industrial subsector has been one of the most active subsectors in terms of acquisition, helping DPU, hopefully DPU accretive kind of acquisitions. As well, we're also seeing a bottoming out of the rents, for the industrial subsector. The next subsector which we are positive on will be the retail. Very obviously, because just earlier in the month, on 28th of March, Singapore government actually announced even more relaxation measures. Increasing group sizes, atrium sales can now resume, and of course the extension of extension in timing for the sale of alcohol. So all of these things will help to lift retail or rather more performances. Yes. However, we do note that amongst the retail counters or the malls in Singapore, we do expect a bit of a lagged recovery for the tourist-dependent downtown malls. So in the sense, we do expect the suburban malls to still remain relatively resilient, while of course the downtown malls will also benefit from return to office. For the office subsector, we note that there is actually manageable supply, and also the return to office should help to lift leasing momentums. In terms of catalysts for the office sector, we see that there's potential redevelopment, more office buildings that could be taken offline for redevelopment purposes, and that will help to reduce the office stock in the midterm, and that could also help rents recover back to pre-pandemic levels. Currently, core CBD rents are still about 6% below the recent peak in 2019. That being said, just want to mention that in terms of valuation, the office sector actually is actually trading at 0.5 standard deviation below the average, meaning to say that there's actually value for the office REITs that we are seeing, and this could be a potential upgrade to overweight in the near term for us. In terms of the hospitality sector, hospitality, there's been a lot of hype about reopening. However, we do believe that in terms of recovery, DPU recovery, the hospitality sector does face a slightly longer runway to recovery, and we expect recovery to pre-pandemic levels only to happen sometime in 2023-24, closer to 24. And of course, the catalyst for the hospitality sector is that as more countries relaxing travel restrictions, as well as an increased willingness to travel, so that would help to lift hospitality counters. Okay, so I don't want to take any more time. I would like to leave more time for the REIT discussion. So I'll now bring us into the panel discussion. Edward, if you could please introduce my guests.
Thanks very much, Natalie. So without further ado, please let me introduce the first of our guests, Mr. Tony Tan, the Chief Executive Officer of CapitaLand Integrated Commercial Trust Management Limited, formerly CapitaLand Mall Trust, and he's been in that position since 2017. He has 14 years of experience managing Singapore REITs, and prior to his appointment at CICT, Mr. Tan was the CEO of CapitaLand Retail China Trust Management Limited. He also has over 19 years of experience in international treasury, finance, and risk management. Our second guest is Mr. Robert Wallace, the Chief Executive Officer of Frasers Logistics and Commercial Trust. Prior to joining the REIT manager in 2016, he led the investment property division of Frasers Property Australia as Executive General Manager. He has also held roles with MAB Funds Management Limited, Jones Lang LaSalle, and Charter K. Kramer. And last but certainly not least, we have Mr. Khim Siew, the Chief Executive Officer of OUE Commercial REIT. Mr. Han has over 26 years of diverse international experience, having worked in Hong Kong, Singapore, Indonesia, and Brunei Darussalam, spanning government, private equity, real estate, and real estate advisory in APAC, Africa, and Europe. They will be speaking with Natalie and taking questions from here. So back to you, Natalie, and your very, very prominent panel of guests.
Thank you, Edward, and a warm welcome to the three CEOs that I have with me today. So we'll be going straight into the panel discussion, and we'll start the session off by tackling some of the more difficult or the top of mind questions first. So first off, a lot of investors are actually concerned about the impact of rising interest rates on DPU and tunnel vision to a certain extent. So to put things into perspective, what are your interest rate hedge and the hedged and unhedged impact on DPU for a 100% rise in rates? Maybe Tony can kick things off for us.
Oh, sure. Thanks, Natalie, and thanks for the introduction, Edward. Yeah, I think this is obviously in the back of many people's mind, and I think a lot of investors are savvy enough to recognize that interest rate has a huge impact on not just the cash flow, right, but also the valuation of the REITs. So for in CICT, I think we have always been, even back in the Capital Mall Trust days, we have always taken a very conservative approach, recognizing that we do have quite a fair bit of a on-balance sheet liability that we need to manage. To date, I think we are looking at more than 10 billion of debts that's on balance sheet that we have to manage, and hence interest rate management is critically important. So historically, we took a relatively, I can say, in fact, a very conservative approach, riding through the different wave of interest rate cycle. We actually had even as high a hedge of almost close to 95, 96%, almost close to 100%, like Natalie did allude to. Today, we are down to about 80%. And I think it's critically important to take a very pragmatic and sometimes a very agile approach, especially in the context of today's scenario where, unlike the last 10 to 15 years, or in fact, last 20 years, interest rate is just going one direction. And in that kind of environment, I think it makes a lot of sense for us to really go long duration in our hedge. So we put in 10, 15 years kind of borrowings through the bond market, get it fixed as much as possible in a very flat environment. And hence today, I think we have a little bit more agility to look at how going forward the interest rate yield curve will shape out to be. So I think this is something that we are on a heightened, you can say, management. As of now, we are about more than almost 85% hedge. If we were to look at a static view, interest rate movement, 100 basis points, we're looking at about 0.2 cents in decline. And that will meaning that we impact the portion that's unhedged. So just to answer the question a long way, yeah, I think it's about 0.2%. 0.2 cents for every 100 basis point changes in interest rate. But again, I think it's going to be quite agile. We'll keep the interest rate management as active as possible and try to put out the long duration when the market permits. And we have different instruments we look at, right? Given that the large liability on balance sheet we have to manage. Traditionally, we've been quite plain vanilla. Either you go to the bilateral bank market, which is a substantial part. Today represent about more than 40% of our borrowing, And the remaining 60%, we are relatively active in the capital market, the debt capital market side. And also quite plain vanilla. We go to straight bonds. We have not tapped other instruments as of now. But given the depth of or rather the magnitude of the on-balance sheet size, I think we have going forward a lot more room to look at potential different market segment of the borrowing market, to look at how we can best tap the market that the best suit us. Yeah. Nat, I think I take up too much time. Maybe let the rest of the panel have a chance.
No worries. Thank you, Tony. We'll move on to Rob. Rob, please share with us your DPU impact for 100% increase, basis point increase in rates.
Thanks, Natalie, and thanks for the opportunity to talk to everyone. I'll be a bit briefer than Tony, just discussing certainly the impact of rising interest rates on FLCT. And I suppose there's two factors we need to take into account when it comes to FLCT, and one is the fact that yes, we too have a significant hedging position at the moment. In fact, about 72% of our borrowings are at fixed rates. So we should be able to weather the storm quite well. I suppose the other second point I wanted to raise, though, is certainly our low gearing. We just closed the sale of Cross Street Exchange on Thursday. So our gearing post that sale will now be sub 30%. So we're certainly one of the lower geared REITs in the market. So whilst obviously we are very cognizant of the fact that we are in a rising interest rate environment, we should be less impacted than some others. And to give you some context, I suppose, in relation to a 100 basis point rise, we'd see as an impact on DPU, certainly something like less than 1% impact on DPU overall. So quite a limited impact at this point in time. And similar to what Tony does, we're certainly looking at different types of financing vehicles and avenues for long-term type debt. And we had our first bond issuance actually last year, which was a sustainability bond under a sustainability framework. And that bond was for a 7-year tenure. So we're certainly trying to push out that tenure as much as we can for fixed rates, just to ensure that we are well positioned should interest rates take an upward swing over the medium, say, term environment. Back to you.
Thank you so much, Rob. Now, Han, can you share with us, your views?
Morning, Natalie. Edward, thanks for the introduction. So similar to Tony and Rob, OUECT has also taken a very conservative approach. We are circa 72% hedged, and for this year, we have only 7% of our debt expiring. So what we're trying to take a more active approach towards our capital management. So we're looking at potentially early refinancing of some of our debt to get a little bit ahead of the anticipated rate rises as well. So these are these are really the factors that we're looking at, and similar to what Tony and Rob have mentioned, the approach has shifted from a more passive towards a lot more active monitoring of the rates and where they're headed, and trying to get ahead of that the anticipated rate rise. In terms of impact, for 100 basis points rise for OUECT, it will be a 0.11 cent impact, essentially. So it's not major, but we do recognize it is something we have to keep our eye on for the next 2-3 years.
All right, thank you so much, Han. Okay, we'll take another top of mind question, which is rising energy costs. So the question is, are you able to pass on higher energy costs, and what is the impact of rising cost expense on your margins and earnings? Maybe we will start off with Han this time.
Thanks, Natalie. We've started looking at it over the last few months, especially closely, and we do see over the last 3 months, utility, especially electricity costs, have started nudging upwards. On a portfolio basis, utilities are circa just under 7% of our overall portfolio. So we have a portion of our portfolio locked into fixed electricity tariffs. The other portion obviously is on a sort of a slightly floating basis. So we're somewhat hedged with regards to the rise in utilities. But again, it is something that will impact our overall sort of distributions if rates keep going up at the rate that they've been doing over the last 3 months.
Okay, next off we'll go to Rob.
Yeah, thanks, Natalie. We're quite fortunate in that regard that really the only impact of property we have from a rising energy cost viewpoint really is our asset in Singapore, Alexandra Technopark. If you look at the bulk of our other 101 assets around the world, typically what happens there is that the energy costs are actually passed through to the tenant. So really, unfortunately for them, they are bearing those costs. We do obviously try to help them out with fixed price contracts where we can if we are supplying the electricity. So overall, we are somewhat insulated, can I say, from the electricity, pardon the pun, but it is certainly something that through, I suppose, longer term contracts, which fortunately we were able to do late last year, it does provide us some protection.
And lastly, to Tony, so how is this rising energy cost going to impact you? Given your malls.
Yeah. So I'm sure Hans and myself is quite envious of Rob. Unfortunately, most of our assets is in Singapore. So as a landlord, we do bear a portion of the utility bill. So the landlord that's in like common area portion, those are the costs that the landlord has to bear. As a percentage of the OPEX, I think I would say overall as a utility bill, that's about 9% thereabout, but largely comprises the energy bill. So there are two components. If you look at the split our business largely between the two subsectors, right? Retail and the commercial office side. Retail side, you probably know that last year there's been a arrangement between the landlord and the retail tenant. Eventually there was a code of conduct that was adopted, and one of the conditions is that whatever cost is going to be a full pass through. Unlike in the past, you are able to go into a fixed contract with your tenant. Rather, you go into a price plus basis with the tenant. I think under the COC, it has to be a full pass through. But on the other hand, the beauty of it is that as a bulk energy consumer, we do have access to direct access to the Genco. So we do hedge. This year we are hedged to the year end. Naturally, it's not a good rate. I think it's gone up to close to maybe it's just short of a one time more compared to last year. So, but that last year it's been abnormally low because last year we also did a hedge, and it was a full long term hedge that got in at the bottom of the market. So it's naturally that it has spiked up. So impact will be, I would say, circle around 9% of our OPEX will be impacted. And the one that we pass on to retail is really just a back to back. We don't get anything out of it, but there'll be a little bit of portion where, because there are still some costs involved in maintaining the infra in our building. For the corporate tenant, generally there's a little bit of markup we pass back on to them, but it's not significant. Yeah.
Thank you, Tony. So now we are going on to some questions regarding opportunities for growth. Some questions on acquisitions. How do you expect asset valuations and cap rates to change in this environment? And can you still make positive carry acquisitions? Maybe you start with Rob first.
Yeah, sure. Yeah, certainly cap rates from an industrial viewpoint, and that's an area that we have quite a weighting to, and in fact 70% of our portfolio now after that sale is weighted towards industrial. Has seen certainly firming of cap rates over the last few years, but we've certainly been looking at the market and studying this, and our view is that certainly those cap rates should maintain at those levels for the next 12 months at least or so. We really see that the buyer demand is coming to is continuing for those properties really as a result of the anticipated rental growth that we have seen, and hopefully we'll continue to see in pretty much all of those industrial markets that we are in. Also helped obviously by very low vacancy rates as well. From an acquisition viewpoint, we still see opportunities both certainly from a passive asset viewpoint in passive industrial asset viewpoint in continental Europe, where there's still relatively low interest rates, and certainly still we can maintain a spread, positive spread, as well as potentially in the UK as well, where there's a bit more yield available for industrial stock. From an opportunity viewpoint as well, I think we'll continue to do what we've recently been doing, and that's buying assets on a fund-through basis industrially. That way we limit our real estate transfer tax liabilities. And we also tend to get a little bit more yield when we do that, as we've done at Worcester, which is just outside of Birmingham in the UK, and we'll also look to undertake development activities similar to what we've just announced at Blythe Valley Park, just outside of Birmingham as well. I think collectively those two projects would be about 80 million in value, and would hopefully be able to do a bit more of that over the short to medium term. But I think importantly, when it comes to growth for FLCT, we just don't want to grow for growth's sake. Our strategy is, and it always will be, to target acquisitions that from a fundamentals viewpoint, being it portfolio metrics as well as returns, are positive to our portfolio. So essentially every asset that we buy, be it a portfolio or individually, needs to stand up on its own 2 feet to warrant that acquisition. So we'll continue to do that. We still think that there are opportunities though out there in an interesting market.
Thank you, Rob. Now moving on to Tony. So your thoughts on accretive acquisitions?
Yeah, you probably noticed you've been quite active over the last 6 months, which is part of the strategy to relook at our portfolio construct. Mm-hmm. At the end, I think we want a portfolio that could carry through this vehicle for a long period of time. And one of the things we did is to really look at window opportunity for us to establish some beachhead in some overseas market, even though we are continuously looking for the opportunity within Singapore, which is still available. So last 6 months, we have done a few transactions. We actually divested one of the office building, 1 George Street, at a fairly low cap, around about 3.1%. And we took an opportunity because there was a quite timely portfolio of 3 office buildings that were available in Australia. So immediately we wanted to seize that with that capital coming back from 1 George Street, redeploy that, and hence you get the uplift, not just from the purely yield spread perspective, but at the same time, we are able to lock in the interest rate at the point in time as well. So I think to answer your questions, there will still be a opportunity to look at transactions. It's still in line with what we going forward continue to do, that journey to improve the quality of assets, and that may involve a little bit of a recycling of some of the legacy asset into something new. That may also include looking at redevelopment, which we would have a sufficient balance sheet to undertake. So there are many ways we look at how we can improve the quality and obviously try to drive growth for our unit holders. To fund that, it all depends on what comes first. If it's just a recycling of capital, then part of the capital recycled could be redeployed, and then you look at what is the most appropriate capital structure for the remaining amount that need to be funded. So it could be a combination of our equity fundraise, or it could be also at a point in time we have the balance sheet in place to fund it completely on balance sheet, which is what we did for the most recent transaction, where we acquired the office building in 79 Robinson, and we find an equity partner to do that along. So a new dimension to look at it is that historically we look at the equity partnership through the public market space, whether it's the debt space and the equity space, the most recent transaction involved a equity partner coming from a private equity space. So I think that's sort of opened up a new potential way of looking at how in future we could more accretively fund the any kind of a growth. So to answer your question, I think in the rising interest rate environment, it is still doable. It's all about the underlying opportunity that may be available. Whether you can unlock some value on the new prospects, and hence it can give you that the bank in the years or year down the road. Then I think that transaction potentially still can be accretive despite interest rate at an elevated level.
Thank you, Tony. Now, Han.
So, as you know, as both Tony and Rob have mentioned, it is becoming harder now to acquire accretively as opposed to sort of 3-4 years ago, with the backdrop of rising interest rates and yields being rather compressed. Having compressed a fair bit over the last 3-4 years, despite the pandemic, really. If we look at it, hospitality assets, there really was no distress for hospitality assets, with the exception of rather sort of non-prime hospitality assets. Similarly, in the retail space, there really was no real distress in Singapore, of note. So as a REIT, we have to think a lot more creatively, and yields are compressing. I mean, we saw the 20 Anson Road transaction, yields are compressing. So we do have to think a lot more creatively. Maybe, for instance, we probably look at build to core to get the extra yield in place. Overseas expansion as well, because yields are slightly higher compared to Singapore in certain overseas markets. Working with partners on a longer term basis. These are the different areas we are exploring to see how we can actually acquire in a sensible way, and not grow just because we need to grow. It has to be yield. It has to be a DPU yield accretive, and we take the opportunistic view on it. So keeping our gearing ratios fairly low to allow us to act quickly when the right opportunity comes up is part of the strategy.
Thank you, Han. Okay, now we'll go on to some other questions regarding price to NAVs. So prices and price to NAVs for REITs holding traditional real estate assets, such as your retail office, have come down, while demand for alternative non-traditional asset classes such as student accommodation, cold storage, data centers, and co-working assets have increased. So is this a re-rating, or should we expect REITs holding traditional real estate classes like office and retail and hospitality to recover to pre-pandemic valuations? So what are your thoughts, Tony?
I wouldn't rule out, because now the natural momentum is on the reopening, and like what you alluded earlier, I think you've seen a bit of interest back into this space, right? I mean, safe to say the last 2 to 3 years, retail and hospitality has been the most badly affected. And then since then, I think you've seen gradual recovery, and with the approach the authority has taken now to be bold, we do think that there's a little bit of a tailwind in this sector that will give that momentum. And obviously, I think there's a bit of optimism in terms of how the rent and for both the retail office will look like going forward. So I'm still optimistic. There's a good chance that we can go back to the pre-pandemic. It may not be this year, may not be next year, but certainly from a directional point of view, it does seems to suggest the momentum is going to be on track. I think, yeah, that's my view. Of course, I think the big question mark is how the cross-border travel that will shape up, right? We have seen a little bit of news flow. If you look at the fly-in, the fly-in traffics, I think certainly is picking up quite rapidly. The land border is just open with Malaysia. I think that will solve some of the issue that our tenant has. Hopefully over time the labor crunch could ease. As of now, I think one of the toughest hurdle to clear is actually the manpower for some of the retailers who actually are quite prepared to expand, but they just can't find the people. Yeah.
Okay, thank you, Tony. How about Rob? Have you been getting a lot of questions on going into the data center space and this general interest towards new or alternative kind of asset classes versus what you traditionally have in your portfolio?
Always, Natalie. Yeah, we're always getting questions about data centers, and that is something that's actually within our mandate. And we have looked at that sector in the past, and obviously, really due to the pandemic, it's enjoyed, certainly from an occupancy viewpoint, a lot of growth. And we've seen certainly some data center REITs and operators do particularly well in the last two years or so. So it's something that we're keeping our eye on. I suppose at the start of the pandemic, like everyone, we were kind of scratching our heads thinking, what does this mean? And I suppose pleasingly from a portfolio which has a pretty big weighting towards logistics and industrial, like 70%, we've fared pretty well, to be honest. Our occupancy for industrials remained at 100% across our global portfolio. And so certainly from a DPU perspective, our DPUs continue to grow. So really we're quite happy with our asset class. As I said before, market dynamics have been quite strong, certainly for the logistics and industrial sector, with very low vacancies, historically low vacancies in many of the markets we're in. And I suppose we look to the commercial sector that represents about 30% of our portfolio. And similar to what Tony said, we're starting to see some nice tailwinds. And I would suggest that with Singapore opening up and other markets around the world opening up, that hopefully physical occupancy levels will improve, which will start to bring back good demand for those properties. But it is a bit of a watching brief at the moment. But I think our confidence is improving as the days and months go by, and certainly people are getting a bit more confidence to go back and work in an office again.
And what about Han? Han, you have OUECT has their fingers in multiple pies, multiple asset classes. You have hospitality, retail, as well as office. So these are all traditional asset classes, and some of the hospitality counters have gone into alternative extended stay kind of assets. What are your thoughts? These kind of new trendy, asset classes versus the traditional asset classes.
I want to say that I'm extremely happy to be overseeing the portfolio that I'm overseeing in Singapore. I mean, we're really well positioned for the leases, that we're signing off. We're seeing it. We're doing the leases at sort of our business plan or slightly better. The office market has clearly bottomed out in terms of rent decline. So we're seeing rents sort of edge up. We're seeing interest for our office take up. It's improving by the week. We've also seen, so it's about 2 weeks ago, it used to take me sort of 30 seconds or less than a minute to go from the ground floor to my office on the sort of 33rd floor of the Hilton Singapore Orchard. Nowadays, last week it sort of took me about 2 minutes. This week it's sort of taken me slightly more, closer to 3 minutes. I'm behaving like a bellhop, where all these sort of hotel guests come in and with all their bags, and I'm like, okay, right, just tap your card. I'll tap the I'll tap the floor, or I'll help you tap the card. Which floor do you need to get to, and all that. So it's taking me a long time. So we're seeing a lot more tourists, a lot more hotel guests coming through. So really pleasantly surprised. It's streaming back very quickly. And probably a little bit faster than sort of we anticipated it will, actually. So really happy with our hospitality basically asset performances. With regards to the new alternative sector, I want to see it as the new economy assets taking away from the old economy. it is very much, an expansion of the global growth of assets and asset classes and consumer taste. So there is a market for all these various sectors. Yeah.
Okay, thank you, Han. Another part of growth, of course, we have inorganic growth, with your acquisition kind of growth. But we also have seen a lot of REITs being very active on the AEI front, Asset Enhancement Initiative front. And in fact, we know that all three of the REITs, they do have a certain portion of your portfolio that's actually undergoing AEI, or there's AEI plans, or there's rebranding exercises going on. So just wondering, moving forward, with construction delays, cost escalations, should we expecting AEIs to take a back seat, or should we be expecting the hurdle rates to come down? Sorry. Why don't we start with Rob?
Well, my response would be not really. Certainly, there has been quite a bit of cost escalation in pretty much every market that we've been in, and we've been very conscious of that. The one thing I would say, fortunately, with the developments in the AEIs we're undertaking at the moment, we've had fixed price contracts, so we've been protected, I suppose, from those price escalations. But what we are seeing as a result of those increased costs is certainly the competing developer market has had to bear those costs as well. And I suppose in order for them to protect their margins, they've had to essentially pass through higher asking rents for their projects. And I'm also talking about industrial here, which as an existing landlord helps us, because it means that any alternative that they are actually developing in the marketplace is going to become more expensive. And that's really helping us with the prevailing market rents within our facilities, and also helping from a tenant retention viewpoint as well. So I personally don't think that these rising costs will slow down development in our portfolio. And in fact, I think in some ways it might actually help our portfolio.
Okay, thank you so much, Rob. What about Tony? We know you have some AEIs scheduled or planned. So what are your thoughts on hurdle rates? Will they come down?
I wouldn't relate. I mean, of course, at the end of the day, it's about what you're going to do with the assets, and there's always a purpose for the AEI. If you're going to tap the potential on the untapped market, then I would say we shouldn't delay. We should proceed, because business requires that. So that bucket of activity should continue regardless. I think the cost structure, obviously, if it's an opportunity that we should seize now, we will do it. And concurrently of it, when do that, we are not, of course, not going in naked, right? Typically, we would at the same time we'll be working out with tenants. So all depends on what kind of work you're looking at. I'll just give you an example what we're doing in Raffles City, the ex-Robinson space. Right? So while we know that Robinson, so that's one classic example. It's a void that we need to fill. And we know that the current setup is not going to be the current setup within the current layout within the old Robinson is not going to be useful going forward at the way we want to plan out the retail strategy. So I would say it is a given we have to do something. And at the same time, when we start reconstructing the internal layout, we are also reaching out for the prospects, right? So you want to secure a certain level of risk that's been exposed and try to lock in as much as possible, so that you have certain minimal risk that you can undertake. But it's at the end, it's a judgment call. I think whether it's a big development or small development, it typically will do that. We try to sound out and seize out a little bit of market sensing where the demand is coming from, and before we embark on it. So that's one example where I don't think we can wait, because the market is evolving. In fact, I think fortunately we push ahead, and we should be on schedule to complete, hopefully to catch the full cycle when the retail peak season will come in by third or fourth quarter. So that's one example. But the other type of capex or AEI, you call that, potentially can wait. It's all about prioritizing. So we have been assessing a couple of the other assets. What you want to do. We know that we have to do something. 2 or 3 years down the road, we may have a big space coming up. Are you going to look at a reconfiguration, or you looking at repositioning the mall? And hence, I think you have to do it. The planning now, but you do not have to secure the contract immediately. Yeah. So it's a bit of different tactics, depends on the underlying property's nature and where it is, vis-a-vis where the competition is. Yeah. So I would say just like what I mentioned about the portfolio construct, this is part of the strategy, right? One way is to improve the quality of the assets. Looking at opportunity to tap some untapped market, unlock some value in the property, and that's what we do actively as a portfolio asset manager as well. So that won't stop. I think regardless of how the environment look like, we just may have to maybe plan it such that it doesn't all crash at one time, where your capital demand may be so elevated at a certain point in time where it may be a bit more problematic from a capital funding perspective. Yeah. So we try to plan out the roadmap in the next 2-3 years, but it can be fast tracked, depends on market situation, but it can also be prolonged. Again, like depends on market situation. Yeah.
Thank you, Tony. And now, last but not least, Han. So Han, one of your major assets has also undergone rebranding, AEI refreshment. Your thoughts on AEIs going forward?
I think most importantly, what I like to say is I'm very glad our 150 million refurbishment of the Hilton Singapore Orchard is finishing up soon, and the contracts have been locked in. So we're very fortunate to be in this position. Going forwards, again, we would have to look at it quite closely and time the AEIs if we do go ahead with the AEIs in where commodity costs are slightly less volatile, where the markets have calmed down somewhat, and we can plan, and contractors don't need to excessively over budget for anticipated rise in labor, anticipated rise in raw materials. We really need to see labor sort of coming through into Singapore in a free-flowing way, without border restrictions due to COVID, really, and for all that to normalize, such that all the costs start coming down a little bit, and we can plan properly from there.
Okay, thank you so much, Han. So we have one question regarding, because interestingly, all three of you are REITs that have actually gone through mergers. So just, based on your own experience, how has this merger helped you, especially, going through the pandemic, and what has it allowed you to achieve that you would not have been able to achieve if you were just a standalone REIT? Yeah, okay, we'll start with maybe Tony.
Yeah, so CMT, CCT, different space, right? Where we were before the merger, CMT retail and CCT was in office space generally. Of course, in between you have a product that we jointly invested in, like Raffles City, which is a mixed use. Well, we think without the merger, you can imagine the impact would be quite a highly volatile cash flow impact to a single REIT on its own. It become a different time. I think during the period of time, there was so much uncertainty in both sector, retail, and obviously it was really a lagging effect, but the lagging effect wasn't that long, right? First thing that hit the market and hit the investor confidence was the retail and hospitality. But very shortly after, people start to question, hey, office is of relevance, right? So you could imagine without the merger, you could have seen a lot higher volatility in terms of income number. With that merger, I think that sort of smoothed out a little bit. With a combined base, naturally you have a scale advantage. You can look at procurement, which we have started to look at in a major way. procurement across different activity, whether it's a energy consumption, which we talked about earlier, procurement for your M&E equipment, whether it's your lift, or your elevator. You can do it on a combination basis, or even your day-to-day operation stuff. Call on multiple contracts, or you can go with multiple contract, or you can go single contract. Your basic stuff like your security arrangement, your cleaning arrangement. So I think there are tremendous scale effect that can arrive as a result of merger. The other part is actually the accessibility to the capital market, which is important. I think with scale, there'll be scale advantage, there'll be liquidity premium, I would imagine. And hence you are able to look at transaction, whether it's the debt side or the equity side on a reasonable size. We can go to the debt market we can do a decent sized debt market, and we can tap essentially the wider audience who may have interest in this part of the world. So I would say there will be other impact that such as the ability to access the capital market more swiftly and quickly and more efficiently as well. Single platform, I think that certainly helps a lot. Yeah.
Thank you, Tony. Now we'll move on to Han. How has the merger helped OUECT brave this pandemic?
Scale does matter, yeah, and especially in the REIT space, scale does matter a fair bit. Ranging from what Tony has mentioned, bulk purchases, agglomeration of services. Post our merger, we saw sort of the gap between our price NAV closed substantially. So that was a plus. We also the enlarged portfolio also allowed us to undertake the Hilton rebranding project, and with a drop off in income as well. If it was just sort of two assets, you couldn't really do that. But we're not a lot larger, so we can undertake these type of AEIs. Last September, we were included in the REIT index as well. So definitely a positive upsides really to the merger.
Lastly, we have Rob. Rob, please share with us your view. Rob, please share with us your views.
We've been very happy with the merger, and hopefully, as to have both the FCOT and FLT investors. Certainly, there's been very good support for our unit price post the merger, and really, I suppose I see three key benefits from the merger. One's the diversification and broadened opportunities that we have, and that's allowed us to acquire, I suppose, mixed-use business parks such as Blythe Valley Park in the UK, something we couldn't have done as FLT prior to the merger, and that's certainly brought on additional benefits after that again. So certainly at that first point we see is a big benefit. The synergies across both the business park and the industrial market and the tenant base as well has been something that's been advantageous to the merged entity. We're seeing that once again at our business parks, where we can actually introduce industrial users as well as commercial users, and they can cross-pollinate, so to speak, the occupancies within those business parks. And we've seen that with, say, Gymshark that we've got at Blythe Valley Park, as well as Lounge Underwear. They're occupying both. And in fact, there are some other potential opportunities that may be able to do that as well at our business park. So it's been quite pleasing and exciting. And I suppose the third benefit I would say would be, as Tony said, the scale. The scale from the merger has been a big plus for the merged FLCT. Our market cap now, as a result of, I think we're about the sixth largest REIT by market cap on the SGX. We're now, post-merger, a constituent of the benchmark Straits Times Index. If you look at the volumes that we enjoy each day, they've probably doubled since the merger as well. And certainly from an AUM perspective, we're about 7.3 billion Sing now. So that is a big plus that has come to us as a result of the mergers. So overall, I think as I said earlier, it's been a a good result for everyone.
Okay, thank you so much, Rob. We're now reaching towards the end of our segment. But before we go, we'd just like to wrap things up with one final question on going forward, coming out from this pandemic and going forward. Is there any I should mention this first. So REIT share prices have taken a beating coming into 2022, but there are many SREITs that have actually been very active on the acquisition and AEI front, and coming into FY22 perhaps even stronger than when they entered the pandemic. So could there be any mispricing in the market? And of course, we would like to know what is your strategy for your respective REITs going forward to unlock value and grow earnings, opportunities, bright spots, and basically your thoughts and advice for investors. So we'll kick things off with maybe Han.
Thank you, Natalie. Yes, some of the unit prices of REITs have not recovered to pre-pandemic, but the downside risk have largely been priced in. For OUECT, we've taken the opportunity during the pandemic to reposition, especially our largest hotel asset. The Hilton has 1,080 rooms. It is the largest Hilton in Asia Pacific. So we've rebranded to the Hilton. It has a large mind share for international travelers, for business travelers. We've repositioned our MICE facilities as well. So we're sitting and perfectly sort of positioned to benefit from the borders fully opening and tourists and travel and business travelers coming through. Our office assets, again, similarly, we've gone through the slightly tougher times of the last 2 years. We do recognize that there's a slight change in work from home, work from office, and we recognize it is here to stay. There are some occupiers who decided, they would not take up as much space, but equally, there are occupiers which realize that they would like the staff back in the office, and they would like maybe say 4 days a week for employees to be back in the office, such that creative collaborations can take place. So they have not really downsized because they recognize there's a health reason to ensure not everyone sort of cramped up together in a little sort of space, and everyone needs that sort of 1 meter extra space. So counterintuitively, yes, occupiers should be taking less space, but with health considerations, they're choosing to keep similar size spaces for the large majority of them. And our asset management initiatives really do, we recognize this trend, and we're trying to make sure we reposition properly for hotel occupiers, for office occupiers, and our retail tenants, and also retail footfall coming through. How the whole sort of pandemic has changed. It has shifted, but it's sort of shifting back again somewhat. Yeah.
Thank you, Han. Perhaps next we'll have Rob. Share with us your strategy going forward and any bright spots and opportunities you see.
Sure. Well, I suppose we've been fortunate that certainly during the pandemic, our share price has been quite resilient. It's held up quite well, and in fact, I suppose over that journey may have actually improved a little bit. So once again, pandemic's been kind, can I say, to the logistics and industrial sector. Certainly over the last few months, you've probably seen that we've done a little bit of portfolio recycling. We announced the sale of a property in December, or late November actually, of an industrial property in Port Melbourne that was at a 100% premium to book value, and then we announced the sale of Cross-Street Exchange, as I said before, which was actually sold on I think it was just under a 2.5% passing yield. So those sales actually give us quite a bit of room on the balance sheet to look at opportunities, and given the yields that they sold at as well, it means that we certainly do have an open window to a number of accretive type opportunities. And we'll certainly maintain that active portfolio management stance when it comes to FLCT. We won't just rest on the laurels of portfolio. We'll look to as our other two esteemed gentlemen on the call, make sure we're maximising the returns that we can for our portfolio as well. So that's really what we're going to do with FLCT, certainly over at least the short to medium term. I think you were asking for my advice for investors as well, what they should be looking out for. And if I was to give advice to investors about opportunities, I'd tell them to look at the fundamentals of a REIT that they're going into, particularly in light of the increasing interest rate environment, and take advantage of those vehicles which do have, I suppose, the best opportunities to grow given those challenges. They should look at the quality of the assets, the strength of the balance sheet of the REIT, the tenant base where the income is being sourced, and I suppose as well, and importantly, look at the strength of the management team as well, who are going to deliver those results. But yeah, overall, I think both AUE and CapitaLand integrated would be great opportunities.
Thank you, Rob. And last but not least, we have Tony. Tony, please help guide our investors and share with us the bright spots for your portfolio. Where else can we see you entering into or growing your presence? Tony.
Yeah. Thanks, Rob, for the kind word. I like your sector too. Yeah, so the way to understand CICT and some of the things that I alluded earlier is that the journey is still ongoing. We are still looking at fine-tuning the portfolio. I'll take this as a multi-year journey. We started since I would say the second half of last year, we started to look at it, and that accumulated into a couple of transactions from fourth quarter until this year. So what to expect from CICT is that those things that we have done, you will expect a little bit of noise in the number, because while you rejig your portfolio, there will be a difference in timing, when the cash flow coming in, cash flow coming out. So in FY22, the number will be noisy. That's a given. But that will create a very stable base for FY23, or in fact, second half of the year onward, FY23. So you should see the number in a positive trajectory going forward. And we'll continue to do that. The journey is not over. We will continue to look at either we can further optimize the existing asset. We can't, do you want to monetize it? You want to monetize it, where we're going to redeploy. So we have existing market as our key strategy. So today we are heavily in Singapore. We continue to look at opportunity in Singapore. And we have already entered Australia, so we keep Australia in our radar. We have completed 2 of the 3 assets that we acquired. The final one should be completed in hopefully in second quarter soon. So that number will come in meaningfully in perhaps in second quarter onward. But it's not the full financial year, which is why I say that there'll be a little bit of noise in the market. So Australia is already in the radar, and we'll continue to look at opportunistically to deepen our presence there. So expect us to be active. And naturally, we are building that for the long-term future. We also started to look at within the portfolio, are we able to scale up in a meaningful way? Some of the assets are just subscale. Whether there's any redevelopment angle, that will take time. Usually, the planning on its own can take 1 to 2 years, and we talk about the final landing and the execution. It could be at 3 to 4 years, but you have to start the work now. And we already identified a couple of within our portfolio things that we see tremendous opportunity for us to put the asset in the best use case. So that journey will continue. So you can look at CICT as a long-term play. We naturally think that we like investors to stick with us for a long time. We have built some momentum since the second half of last year. Hopefully the income stream will come in. With completion of a couple of development projects late last year and beginning part of this year, again, meaningfully, you'll see income stream and the cash flow coming in from second half onward. And then we are looking at planting new seeds for the new growth in the form of either a new acquisition or in the form of a new redevelopment opportunity. So it will be a continuous journey. But safe to say, we have been quite transparent in what we want to do. And we also been very vocal about what the portfolio construction look like. Long to medium term, it will be heavily focused in Singapore. I think this is coming out very clearly from our investors. When they invest in us, they just don't want us to be in all different places. So they want to have a very concentrated bet. So we'll keep that as part of an important strategy. So while I mentioned that we start to look at beachhead in different market and then try to deepen it, that's really just to give the vehicle a long-term optionality. As everyone knows that Singapore is a finite market, 10 years down the road, if you continue to go on that kind of trajectory, and imagine one building that will be taken down, and we just give that Singapore as the key source of income replacement, then I think the vehicle will go through a significant kind of volatility income stream, which is not what I think investors want. So I think that's the main message to our investor. And hopefully the audience here will take that as a takeaway as well. Put your money in this stock for long term. Yeah.
All right. Thank you so much to all three CEOs who have joined us this Saturday. And thank you, Tony. Thank you, Rob. Thank you, Han, for joining us. And with that, I think we come to the end of our REIT segment. I'll now hand the time back to Edward.
Thank you.
Thanks, Edward. Thanks, Natalie.
Thanks for inviting.
Thanks, Natalie. And also thanks again to our CEOs, Mr. Tony Tan from CapitaLand Integrated Commercial Trust, Mr. Robert Wallace from Frasers Logistic and Commercial Asset Management, and Mr. Khim Siew from OUE Commercial REIT Management. Folks, sessions are recorded and will be available next week in case you missed anything today or last week. Just click on the recorded sessions button. But coming up this afternoon, we will be talking even more about Singapore REITs, China ETFs, behavioral science in investing. And we'll also be ending off with a Cantonese session exploring whether the markets are currently risk on or risk off. Tell us whether we should buy stocks. You don't want to miss any of these. So do join us again at 1 p.m. Do check out our exhibition area also. Enjoy your lunch. See you at 1 p.m.